Analysis part 5. So in this part, we're going to go through candlestick. Now, this is a little bit of a longer part, so it may take a bit longer than the other ones we've done because there's a bit more information to go through. It's mainly looking at different types of candlesticks that can form. So when you look at candlesticks, it tells you more than sort of just basic information. It can also give you predictive indicators. It can tell you information over what's happened in the session, and you can also then sort of break that down. In the next part, we're going to go through top-down analysis, breaking it down into smaller parts. But candlesticks can actually give you a lot more information than you might think, where you can use them to predict what may happen in the future and also understand what's happened at certain places of context, like levels, Fibonacci areas, moving averages, all these sorts of things, how the price interacts, right? Because at the end of the day, candlesticks tell you the story of price. So it's the price action as time goes on. So let's get started and look through candlesticks. So understanding now what's the meaning of a candlestick. So like I said before, each candlestick tells you a story. It's the story of the price. And it's the story of the price on that time frame. Because remember that there's multiple time frames, the 1 hour, the 4 hour, the daily, weekly, monthly. And if you look at a daily candlestick, that's going to tell you the story of what happened during just that one day. So the open price, the low price, the high price, and the close. And of course, that in itself tells you a lot. And when we look at the next part as well, you can then break that candle down into more candles on a lower time frame that made up that higher candle. But we'll get to that, of course, in due time. But each of these candles tells us a story. And in this part, we're going to understand what that story might be and whether it can indicate bullishness or indicate bearishness or just kind of sideways movement, and how we can interact with those ideas. So because they're representing that certain time frame, you can then extrapolate that larger or make it smaller, as I said, using top-down analysis, which is the next part, to understand a bit more. So this is like part 1, and in the last part, we'll come back to these ideas again of the candlesticks and how we can look into it in a bit more broader sense. So here you have a nice green candlestick. So remember the open, high, low, close idea. Now, it has a green body, so it closed bullish. And of course, you see that the charts that I've used during the presentation are blue and white, because personally for me, I use white and blue, white for bullish, blue for bearish. You can use any color you want, but the most common, of course, being green for up. So the open price is going to be where the bottom of that green body is. The lowest that candle got during the session is the low of the wick. The highest it got is actually where it's closing, because there is no wick to the upside. So it's closing right at the high. Move lower during the session, close right at the high during the session. Now, that is going to tell you some things, and we'll go through these. So because of that long wick at the bottom, the price clearly during that session, let's call it a daily candlestick. During that day, price opened, it pushed quite a lot lower during that session. So maybe it pushed into a support level, was then bought back up again. There was a lot of pressure to the upside, a lot of demand coming into the market. And at the end of the session at 10 p.m., that candle closed so bullish that it didn't even pull back at all at the end of the day. So clearly that's going to tell you some information, especially if that's in an area of context. So if that candle occurs at a support zone, that shows you there's a lot of buying at support. It may then give you the idea that, okay, well, if we've entered support, we've moved away from it quite strongly, perhaps the market might continue moving away, and you can look for clues for that on a lower time frame if you wish. So that's why it's important. Location, location, location. Same thing with real estate. It's where it is that matters. You can have a really nice mansion, but if it's in the middle of nowhere, it's not going to be worth as much as one on the seaside, right? So it's all about where the location occurs, and that's going to matter as to whether you pay much attention to it or not. So we know that this is a bullish candle because it had that green body, it's closed very bullish at the end of the day, and during that session, we pushed down quite strong and then pushed right back up again at the end. Now, imagine now that we do have that large area of support. If that happened in the middle of nowhere and there's just nothing really going on, it's just kind of going nowhere, then it may not be so important. But if we've come down really strong before, let's say the 4 or 5 previous days before that candle are like really big red bearish days. We've reached a level that we have marked out on the chart, and all of a sudden we've formed a candle like this. That tells you a lot of information. It's really quite a bullish candle. So we're pushing lower into the area of support, rejecting the area, and closing bullish. It may give you an indication as to what may happen the next day. Because if this has happened yesterday, well, maybe tomorrow we won't go back down to the level. We might continue pushing higher. And that's when the next part will come in handy when we look at top down, because you can then understand that if you see this, what might you then look for in a lower time frame? Or maybe you might want to, depending on different people have different strategies, they might just buy as soon as they see this sort of candle forming at support, because they've got an idea as to the bias of the potential next days. So let's start off then with going through all of the different candlesticks. Well, it's a bit of a longer part because there's a few to go through, but definitely stick with it. Make sure you understand what these candles mean and also backtest it. So if you then go onto a chart, try and find these candles at levels where you can see markets turning around or doing certain actions, and you can see how they actually work in a live environment. So doji candles are the first ones. Now, there's a lot of Japanese sounding names throughout this part, and it's because the Japanese actually invented the idea of candlesticks. So hundreds of years ago, they were using, or someone in Japan came up with this idea, I'm pretty sure it was with rice markets. So they were like looking at the price of rice over time, and they were inventing these candlesticks to sort of give them an idea as to where the price might be heading. And since then, it's caught on, of course, pretty well with markets in general, and that's why you're going to hear a lot of Japanese sounding names, a bit of a backstory there. So doji candles part one. Now, the one on the left here, long-legged doji. Some funny names on the go, but really you don't really have to remember exactly what the name is. As long as you understand the context of the candle, if you can look at a chart, see one of these candles and understand what's happening, that's the important part, not sort of stressing about remembering like dragonfly or long-legged or all the other ones. So the names aren't so important, it's the context. Now the long-legged has, of course, you can see a long upper and long lower wick, roughly equal in length. And the middle part is where it's closing, right? So you have that middle line means the opening and the closing price is the same, pretty much exactly the same. So you've moved lower during the session, you've moved higher during the session, but you've closed exactly where you started. And you went up and down roughly the same amount. So really it's a candle that signifies indecision in the market. It's consolidation on a lower time frame. Because if this is a daily chart, try to imagine what the 1 hour chart might look like. Well, if it's opened at that middle price, it's gone up and down during the session and closed where it started, it probably just looks like a consolidation range, as we looked at before. So that's what I mean by each candle can tell you a story. You can then go down and look at what that story actually is on a lower time frame. So it's like a neutral candle. It shows you equal buying and selling, equal supply and demand. So if you saw this happening at a resistance level, you see a couple of these candles, on a lower time frame, the market's just consolidating at the level. And of course, you can box the level off and then decide what to do after that. Now, the one on the right-hand side, there's only a slight difference to this candle, but it tells you a lot different information because the market opened at that quite high price, pushed down a lot during the session. So there was a huge amount of selling as that session started or halfway through. And towards the end of the session, all of that selling was completely undone and brought right back up to the high again. And there was some higher price action that sort of came down slightly, but that's a much more bullish candle than the previous one because it actually shows you that there was so much selling during the session, but the market came all the way back up again. So imagine seeing a candle like that at a support level, wicking down through support and closing back up above. That tells you quite a lot because the market's tried pushing lower, it's tried breaking support during that day, during that week, but then it's closed really nice and high again towards the end of the session. So see how two candles that might look similar if you just glance across, but they actually do tell you quite different information. So a neutral candle and a bullish candle. So part two of the dojis. On the left-hand side, you can see the gravestone doji. So it doesn't really matter if there's a slight wick at the bottom or there's no wick at all. It's kind of similar to dragonfly, but upside down. So now we have a really long upper wick and little to no lower wick. So just showing us that the price has attempted to push a lot higher during the session, but it's failed to do that. Let's use an opposite example now, right? Let's say that you see this at a support level. So instead of resistance, of course, if you see this at resistance, it's tried pushing higher, it's closed quite low. It just shows rejection of the level. Now try and flex your brain a bit and think, what if you see this at a support level, like low in the market? Well, let's say it's a daily candle again. During that day, the market's hit support. There's a lot of buying at support. It's pushed the market up. But then towards the end of the day, it's really failed. That buying has failed and it's come all the way back down to support again. So you sort of ended where you started and you're all the way back down at support. Might not be so bullish at all, because otherwise the market should have closed a lot higher. So it can give you different indications in different contexts. And if you saw that candle at resistance, that's pretty bearish in certain circumstances. And as you go through, as you develop your trading career and you sort of get used to candles and looking at charts, all this will become a lot more intuitive. Whereas at the moment, it may be the case that you have to think of these over and over again. But yeah, as you see more charts and you get used to it, it will become a lot easier. On the right hand side, for price. Now, really, it means nothing. So you may see a candle like this on Christmas Day, during public holidays, on less traded pairs, because it really means there's not anything happening at all. So it doesn't give you much information. It's just nothing has occurred. So the market is opened and closed at the same place and has not moved up or down during the session at all. It's quite rare you'll see these, but it will be during times of massively reduced volatility. So bearish candle also could be neutral, so on the right there, but it doesn't really mean anything at all, to be quite honest. So spinning tops. Now, spinning tops are like dojis, but with some bodies too. So let's say you had a long-legged doji, which was like a large wick to the bottom and the top, closing and opening roughly in the same place. It gives you the same information as this candle, it's just it looks slightly different. So it's a neutral candle, but just with some bodies. Whether it's green, whether it's red, it doesn't really matter. It just shows you that the market is sort of consolidating or ranging on a lower time frame. So if we look here on the right-hand side on the chart, you'll notice that there's a pretty strong, heavy downtrend on the way down. And as you approach the low, you put in quite a few different candles, but at least 4 of those candles could be classified as spinning tops or dojis, because you have the market putting in decent-sized wicks on either side, roughly equal, and closing very, very small bodies. So there's no direction. And I drew a box across there. You can imagine on a lower time frame, the market wouldn't really be making any specific direction. It's just going sideways. So spinning tops can indicate potential trend reversal if they happen at the bottom of a trend. If they're happening halfway through a trend, it could be a continuation. The market's just taking a break. But of course, you always have to go down and check what the lower time frames look like to see how this might look and how you can use that information. But spinning tops, much like dojis, neutral candles, pretty much just going sideways. Hammers / pin bar. So really it's the same thing. It's just interchangeable words you may hear. So a hammer and a pin bar goes back to the one we first looked at, because you have, in this example, a bullish candle because the market has opened, pushed quite a lot lower during the session, and then closed all the way back up at the high again. It can have a slight wick at the top. It can have no wick at all. If the wick is too large, it then becomes a bit more of a spinning top, because of course you don't want it to be sort of in the middle. You want it to be more to the upside here, showing a bullish candle. If this happens at support, you've wicked down into support, the market's been bought back up again. If this happens at a resistance level, or maybe you've come into resistance during that session, you've sold off pretty heavy, then you're all the way back up at resistance again. So it can be kind of bullish in both scenarios, up and down. So here's an example of that, where you have a pretty strong downtrend again, and you then form a pretty big bullish hammer. And notice how the wick breaks and closes. It breaks down, doesn't close, but it breaks down through the previous low, but then closes all the way back up again. And that can indicate a continuation in the market in the other direction. So in this case, signaling a potential reversal candle. And it's not always going to be, it's not 100% like this, but these candles can often give you signals where the market may be turning around, again, in the right places with context. Hanging man, right? It's kind of a strange name, but this is a potentially bearish candle. Now you notice that the hammer is the same as this really, but just a different color. So what we're now thinking about, remember the idea I said, where if it was a hammer candle, like a green body, a bullish close, the market comes into resistance. It can sell off during the session, but then it's bought back so much that you pretty much go all the way back up to resistance again. So it may break through the next day or something. You've made a sell off and you're right back up again. Well, the hanging man is like a similar idea, but bearish instead, because you've sold off during the session and you've just come back up a bit. So it could be the case that on a lower time frame, the low of that wick is the beginning of the B retracement for the downwards AVC, and you just happen to have closed at the top of the potential B. Next day it breaks down through. But of course, you would have to go to the lower time frame to see if that's actually the case or not. But the hanging man is a candle that can often form at highs. So you have to sort of watch for these potential candles. go down and see what's happening on lower time frames. It's one of those candles where you wouldn't necessarily take action based on this candle alone, whereas sometimes you would with a hammer, but it can give you an indication as to what may be occurring. So look at the right hand side on the chart. You have a decent size uptrend. You form a hanging man where you have a bit of a blow off top. It goes pretty strong, and then the hanging man forms. You then form a second one. It is a bullish close, but it's still it's a hammer / hanging man. And then the next candle after that is what's called a shooting star. So the market really keeps trying to move higher, but it can't do so. It keeps moving lower instead with wicks to the downside. Has a final attempt at moving higher, closes all the way back down again with a red bearish close, which is I think the next candle, the shooting star, as the third one after the box. So shooting star is the opposite of the hammer. So quite a large size wick to the upside, but closing really quite bearish, either with no wick at all to the downside, or a small wick. So a very bearish candle. Now there's a reversal. So of course we saw this candle. I'll go back in a sec to the other chart, but strong uptrend. Notice what the previous candle looks like, right? A huge green candle, and immediately followed by a shooting star. So the market's just stopped dead in its tracks. It's tried to push high during the session, but it's closed really down quite strong. So these candles will always take different forms, but they're roughly going to be in a similar look. So if we take the idea of this candle and go back to the previous example, look at where I've boxed off the hanging man, and then two candles to the right is the same candle. So you've got a hanging man, then you get a shooting star. The market just cannot move any higher and closes right back down again. And that can give you an indication as to what may happen afterwards, and the trend then reverses. And again, if that's at a resistance level, it's really important. It's very good context. So that's our shooting star, opposite of the hanging man, really quite bearish. And imagine this happens at support. Well, the support level, you've come into the support, you've bounced away during the session, but there was no real conviction in that move. It's right back down to the low again, right back into support. Marubozu, very like Japanese word here. So Marubozu, there's two types, a bearish Marubozu and a bullish Marubozu. And these are simply candles that are so strong, there's so much kind of volume and buying and selling in that session that there's really no candle or no wick on the closing side. So you can see here that the left-hand side has a small wick to the upside. It opens up the high, closes down at the low. Marubozus have no wick at all. So the session closed so bearish that there was no buying at the end of the session. Or the candle, the session closed so bullish at the end of that session, there was no selling at all into the close. It just closed right at the high. So either there's going to be no wick at all either side, or just one wick on the opposite side. So looking at an example of this, on the left-hand side, you can see like a pretty decent-sized Marubozu. There is a minute wick. There can be a tiny wick like that, really no noticeable one. It does start to retrace immediately after, but it continues that small trend. And then you get a massive, again, selling pressure to the downside, and the market continues going down. So it's not always the case that immediately after you keep selling off or keep buying up, because the market might take a break, but it can give you a pretty decent indication as to what direction the volume is heading, right? What direction people are actually trading, because it's moving so quickly. So you see this on a weekly chart. The next week, you might be looking for shorts as the market starts pulling back a bit, because last week was so bearish. You might pull back into resistance and then try and short it there. There's so many opportunities. Morning star. So we're now getting into the patterns where we're looking at more than one candle. So whereas the Marubozu candle, the hanging man, the shooting star, they're one candle. These are now multiple candles that give us an idea of a potential pattern. So what a morning star is a 3-candle pattern where you have downwards movement. It can look like anything. It could be a massive Marubozu, it could be a shooting star, it could be, I don't know, dragonfly doji, all these like bearish candles that's then followed by a candle that sort of stops, right? So either it could be a hammer. The second candle could be a hammer showing like rejection of a lower price. It could be anything really. It could be not a shooting star, sorry. It could be a hammer. It could be one of these candles here. It could be a 4 price. It could be a long-legged. It can be the one with the small bodies. It doesn't really matter. It just needs to show like a slowdown in the price, and then followed by bullish price action. So what you essentially have is the market dropping hard, slowing down. Volatility is like slowing quite a bit, hitting a floor, so to speak, and then the next candle is showing bullishness. So it's almost like imagining the bull dropping to the floor. That's the first candle. begins to bounce, that's the second candle, and then bounces up as the third candle. That's the way of thinking about it. So any of those number of candles can be in the middle, but it's bearish, neutral / bullish, and then bullish again. So here you can see really quite strong downwards movement on that first candle. The second candle closes only a little bit below where the previous candle closed. It tried to move higher, tried to move lower, didn't really close that much different to where the previous session did, and then that's followed by a pretty massive hammer. And see how the price never got below the low of that hammer, it then reversed after some consolidation. So either it's going to move immediately, or it's going to consolidate a bit first. They can give you an indication as to where the market might be turning, might be heading. So that's the morning star pattern, one of those multiple candle patterns. So then the evening star is the opposite way around. So now we're thinking of bullish price action. It could be the hammer, bullish Maribozu, any sort of standard bullish candle, followed by spinning top, long-legged doji, gravestone doji, shooting star, you name it. Any sort of stoppage candle or bearish candle, which could signify a change in the momentum, and then the momentum following through on the third candle. So now we're throwing the ball to the ceiling. That's the first candle. Second candle is the ceiling stopping the ball, starting to bounce away, and the third candle is then the drop. And there we can see bearish candlestick pattern, buying pressure, evening star in the form of generic bullish candle, spinning top, and then generic bearish candle, and that then precedes the reversal. Tweezer tops and tweezer bottom. So these are effectively like hammers times 2 or shooting star times 2, where the tops and bottoms are roughly equal in where the price is. It doesn't have to be exactly the same, because of course if one of them is like a few pips higher or lower than the other, if it's a weekly chart, it could be 10 or 20 pips higher, but as long as they're roughly in the same place, it's signifying an attempt to breach higher prices twice or breach lower prices twice, but both times closing back up again. So here we have a tweezer top pattern where the right hand candle is just slightly higher than the left, but you have bullish candle, then pretty decent sized wick to the upside. Next candle goes to roughly the same price, then has a massive sell-off. So that's a tweezer top pattern, because like the top 2 wicks are almost like a tweezer. And that can potentially signal a reversal. And if you just a side note, if you look at the beginning of the uptrend, so where the U of that word uptrend is, the candle above that is sort of like a dragonfly doji with a tiny little body. So it's like you said, a dragonfly spinning top or whatever, pretty much a dragonfly doji. The wick breaks below the previous lows, closes right back up, proceeds bullish momentum. And then you see the next candlestick pattern, tweezer tops, proceeds the bearish momentum. So that's how you can use these candles to predict what may occur with context. Last view, we've got the bullish engulfing pattern. So again, multiple candles. So here we have one candle that engulfs the entire price action of multiple previous candles. And you want, at least one, obviously. And the more candles it engulfs, the better. So here we have an example of one bullish candle engulfing 3 previous bearish candles. So extremely bullish, because it's almost like it could be a Maribozu that does this. You could have like a Maribozu / bullish engulfing, or you could have a massive hammer / bullish engulfing, where that one session just engulfs all the previous sessions. So it's clearly showing you that something has occurred and the market's completely switched from supply mode to massive demand mode. And here you can see market's trending downwards. You get a sudden explosive move to the upside, engulfing 1, 2, 3, 4 entire bodies, and then actually 5 entire bodies, and then that very first candle doesn't quite engulf the wick, but it still engulfs most of that candle's price action. So almost a week's worth, let's say it's a daily chart, almost an entire week of price action undone in one day. So the last red candle could be Friday, you come into the market on a Monday, all of a sudden bang, straight all the way back up again. Well, that's probably going to indicate a potential change in direction of that trend. Potentially, it doesn't have to, but potentially could. And of course, the more it engulfs, the better. In that case, bearish engulfing, the opposite way around. So here we have bearish engulfing, multiple up candles, bullish momentum, all of a sudden, massive bearish momentum. So it could be Maribozu, just a standard generic downwards candle, or it could be like a shooting star or something. But then, that massive bearish body closing below multiple previous candles. Very, very bearish pattern. And there you can see. So you have 3 entire days of price action in terms of the closes and bodies engulfed by one candle. So that may give you an indication that something's occurred up there. If there's, let's say, there might be a moving average up there, that this might occur at the 61.8% fib. That may indicate something, and there's a lot of selling pressure coming in as it reaches that area. So again, can give you a predictive indicator as what may happen with future price action. And finally, we have the inside bar pattern. Now the inside bar, there's a lot of information on this sort of on its own, but this is essentially when you have volatility contraction, where one candle will close within the previous candle. So it's only really used on higher time frames, so the daily chart and the weekly chart. So inside days, inside weeks. Really, we're looking at a candle where the mother candle, which is like the big candle that starts the inside day, then has what are called daughter candles. So you can see on that right hand chart there, the boundary is to the higher and the lower of the candle. And we're talking about wicks now, not bodies. So the entire range of that session, whether it's daily or weekly, the next candle after that is completely within, including the wicks, within the high and low of the wicks of the first candle. And you have actually 2 inside days or inside weeks on that chart where the volatility is contracted so much that you sort of struggle to move above the high or the low of just that one session that happened 2 weeks or 2 days ago. So there's many indications that can come from this. Doesn't necessarily give you a bias in this basic form. There are more advanced forms of it. I'm not going to go through that now. But in its basic form, it just shows that volatility is contracted. If this happens at a level and you start to form multiple inside days, maybe the individual candles can give you an idea. If you have some spinning tops, some long-legged dojis that are inside the previous day or week, volatility is contracting at a level, you're starting to range, maybe you can then go to the lower time frame, box off the range, and potentially wait for a break of either side. If it breaks up through the level, you then may buy the B retracement as it's coming back down to retest the previous resistance area, but now could be support. You can obviously build on top of that moving averages, Fibonacci, trend lines, ranges, channels. So all these sort of things we've been learning. So that's the candlestick patterns, the candlestick formations on their own. Of course, quite a big part there, like I said, but hopefully that's going to clear up your understanding now of the charts. You can go to a chart, look at these candles, go back through charts, back test it, look at high and low turning points on multiple time frames. And when we go through the next part, top-down analysis, I'll show you how you can sort of visualize what may constitute one of these candles. So where you have that really big green bullish candle there, that's obviously made up of 24 smaller candles. If that's a daily chart, then that one candle is comprised of 24 hourly candles. If it's a weekly chart, comprised of 5 daily candles, because the market only opens 5 days a week. So I'll show you how that works in the next part. But until then, enjoy that. Go back and have a look at it on the charts, and I will see you in the next and final part.